Hello everyone, welcome back to another video. In today's lesson, you will learn to prepare the bank loan account and also calculate the interest expense for multiple periods for a question which involves many complications. You will see the question on the left hand side of the screen, and on the right hand side we have all the workings which I'll go through step by step. What I need you to do now is to focus and concentrate for an excellent understanding. So let's begin. Zeus Limited runs an ice cream shop. On 1 March 2022, the business obtained a 5-year bank loan of $90,000 to purchase a motor vehicle at 10% interest per annum. The partial principal sum of the loan and interest are paid every 6 months on 31 August and 28 February. So let's understand simply what's happening in this paragraph. So we know that we have taken a 5-year bank loan, and that amount is $90,000, and the interest rate on this bank loan is 10%. This loan was taken on 1 March 2022. We repay this loan every 6 months. We also repay the interest every 6 months, and that 6 months are on 31 August and on 28 February. The financial year end of the business is 31 December. So we are working with a business which prepares its financial statements at 31 December, which means its financial year should always start on 1 January. Okay? So 1 January is when the financial year starts for this business, and 31 December is when the financial year ends for this business. The requirement for the first question is to prepare the bank loan account for the year ended 31 December 2023. All right, so let's look into the workings on the right hand side. All right, so first of all, we understand that the loan was taken on 1 March 2022, and it is a 5-year loan. In 5 years, how many semi-annual periods do we have? Or how many 6-month periods do we have? We have 10 semi-annual periods in 5 years. How is that so? In 1 year, we have 2 semi-annual periods because we have 6 months twice in 1 year, right? So in 5 years, we're going to have 10 6-month periods or 10 semi-annual periods. Now, we know the loan is repaid every 6 months. So on that basis, if I want to calculate the loan repayment every 6 months, it's simply the loan amount of $90,000 divided by 10 6-month periods or 10 semi-annual periods, which means every 6 months we repay $9,000 of the loan. Okay? All right. Now we need to look at different timelines, which can get complicated. So I need you to focus and concentrate. All right. So the loan was taken on 1 March 2022. So from 1 March 2022 until 31 August 2022, we have a first 6-month or semi-annual period. The reason we ended at 31 August 2022 is because we know that at 31 August 2022, we are making a principal repayment for the loan and also some interest. Since we are preparing the bank loan account, we are focusing on the principal at the moment. All right, so we know the loan repayment is $9,000 every 6 months. So on that basis, on 31 August 2022, we're going to repay $9,000, right? After the $9,000 is repaid, the loan balance will be $90,000 minus the $9,000 which we have repaid, which will give us a loan balance of $81,000 at 31 August 2022. Okay? All right. Then let's focus on the bank loan account now. All right. So first of all, this loan balance of $81,000 that we have left on 31 August 2022, this will become the closing loan balance at 31 December 2022, right? Because up to 31 December 2022, we are not making any more repayments, okay? So this means this loan balance of $81,000 at 31 December 2022 would be carried forward as the opening balance on 1 January 2023, okay? Based on the requirements of the question, if you have a look on the left-hand side, you will see in question A, we are required to prepare the bank loan account for the year ended 31 December 2023, which means we're focused on what's happening from 1 Jan 2023 until 31 December 2023. Okay? All right. So here we have the bank loan account, the ledger account format for the bank loan account, which is the 5-column usual format that we follow. So we are starting 1st Jan 2023 with the opening balance of $81,000. All right. How did we know it's $81,000? Because just a while ago we had a discussion of the closing loan balance at 31 December 2022, which was $81,000. Now, bank loan account by default is a liability account. In this case, it's a non-current liability account because we're repaying the loan over multiple periods, which is over 5 years or 10 semi-annual periods. Therefore, this falls within the category of a non-current liability. We know that all liabilities by default should have a credit opening balance. Also, all liabilities, when they increase, they should always be recorded on the credit side, and when they decrease, we always record it on the debit side. So we are starting the financial year on 1 Jan 2023 with the opening balance, which is recorded on the credit side, $81,000, which gives us a final balance of $81,000 credit. Okay? Now, we know on 28th February, based on the company's policy, we're making a loan repayment. And when we're repaying the loan, our liabilities are going down, right? If liabilities go down, we debit it. So that's why on the debit side, we have included $9,000, which is the regular repayment that we make every 6 months. Now for the details, we have written cash at bank. Why is that so? Let me ask you the journal entry for the loan repayment of $9,000. If you're repaying loan of $9,000, you would debit the bank loan account. Why would you debit the bank loan account? Because your obligation or liability is going down. So you would debit the bank loan account by $9,000, and then you would credit the cash at bank account by $9,000 because you're using your funds available in the bank account to make this repayment. And the cash at bank account is an asset account. If assets go down, we credit it. That's why you're crediting the cash at bank and debiting the bank loan account. So when you're debiting the bank loan account, you are using cash at bank as the opposing credit entry. So within the bank loan account ledger account, we're recording $9,000 on the debit side, with the details being the cash at bank, because we're using the funds available in the cash at bank to make this repayment, if that makes sense. So which gives us a final balance of $72,000 credit, because $81,000 credit minus $9,000 in debit leaves us with $72,000 credit. Okay. Then we have made one more repayment during this year, which was on 31 August 2023, as we already know the company's policy. And again, we're making this repayment using our funds available in the cash at bank account, and bank loan account would go down because our liabilities are going down, our obligations are going down when we're making the repayment, and when liabilities go down, we debit it, and that's why we're recording $9,000 on the debit side, which would leave us with a final balance of $63,000 credit, which we get by simply subtracting $72,000 credit and $9,000 debit. Okay? All right. So this $63,000 credit will be carried forward as the opening balance in the new financial year starting 1 January 2024, and we'll write balance brought down of $63,000 credit, obviously, because it's a liability account. All right? So that completes the bank loan account in itself. Now, you can only expect to get better in this question by your exam and get full marks with multiple questions of practice, okay? And you will see that I'll be uploading many videos, so make sure to subscribe and like this video so you can get notified every time I upload a new video, okay? All right. Now, the next question is asking us to prepare journal entries to record the interest expense for the year ended 31 December 2022, including the closing entry. Narrations are not required. All right. So many complications are involved here. So let's see what's going on. All right. First of all, we know we have taken the loan on 1 March 2022, and the first 6-month period would have ended on 31 August 2022. Okay. So we have a time frame here from 1st of March 2022 until 31 August 2022. In between this time frame of 6 months, let's calculate the interest expense. We know the interest rate is 10%, all right? And then the loan amount initially was $90,000. And because we're calculating the interest expense for 6 months, I will be multiplying 6 over 12, which basically apportions this 10%, which is the annual rate, into a 6-month rate. Because when I do 6 over 12, it's basically saying that it's 6 months out of 12 months in a given financial year. And because the 10% in itself is an annualized rate, we're converting the whole amount, okay? So that leaves us with $4,500 as the interest expense calculated from 1 March 2022 until 31 August 2022, okay? Based on the question, we understand that at 31 August 2022, we have made a loan repayment of $9,000, which you recall from the previous question, plus an additional interest repayment. So this $4,500 will be paid using cash at bank funds at 31 August 2022, okay? All right. Now, just to recall, the loan remaining at 31 August 2022 would be the $90,000, the initial balance we had, minus $9,000, which we had repaid, if you recall from the previous part, and that would leave us with $81,000. Now, why did we do this? This is because from 1 September 2022 until 31 December 2022, which is the end of the financial year, and the requirement of the question, as we are supposed to journalize the interest expense for, what we're going to do is calculate interest expense again. So in between these 4 months, starting 1 September 2022 and ending 31 December 2022, I want to find the interest expense incurred, which will be 10%, the given annualized percentage, multiplied by $81,000, which was the balance left at 31 August 2022, all right? Multiply 4 over 12. This is because from 1 September 2022 until 31 December 2022, we've got 4 months. How is that so? September, October, November, and December. So that's 4 months. So here we are apportioning the 10% annualized rate into a 4-month calculation. Okay, so that gives us $2,700 as the interest expense we would incur in between these 4 months, starting 1 September 2022 and ending 31 December 2022. Okay. And this $2,700 is not paid at 31 December 2022. Why is that so? Because we know we make the repayment every 6 months, which was on 31 August and on 28 February. So when we are journalizing at 31 December 2022, this $2,700 would be an accrued interest expense or interest expense payable because we would not have made this payment using our cash at bank funds available. Okay? All right, now let's look into the journal entry. All right, so we understand that there will be $2,700 in accrued interest expense or interest expense payable. Because we haven't paid this interest expense, it falls within the definition or category of liability. All liabilities when they increase are credit. So that's why we are crediting interest expense payable by $2,700, okay? All right, during the year, we know at 31 August 2022, we have made payment of $4,500 for interest expense using our funds available in the cash at bank account. So when we make the payment using the funds available in the cash at bank account, the cash at bank account is going to decrease. Cash at bank account in itself is an asset account. And when assets decrease, we credit it. So that's why we are crediting the cash at bank account by $4,500. Okay? All right. So altogether, these two credits add up to being $7,200, which is in fact the total interest expense for the financial year ending 31 December 2022. And also this fits within this logic because all expenses by default are debited. Okay, so in between 1 March 2022 and 31 December 2022, the total interest expense we have incurred is $7,200 and all expenses are debited, so that's why we are doing it anyway. Okay. Now, we also have to record the closing entry. So what do we understand by closing entry? We know that all revenue and expense accounts are temporary in nature, which means that at the end of the financial year, they're always reset to zero before we start a new financial year with zero opening balances. This is mainly done using the accrual basis accounting theory, or the matching concept, which allows us to recognize or calculate profit accurately. Okay. Now, how do we do this closing? So it's pretty straightforward. So I'll just show it to you. So the closing entry is basically we have to close this expense accounts against the income summary account. All right. So what we're going to do is we will credit. If we want to close the expense account, we have to reduce the expense account. We know expense accounts when they increase are debit, right? So now that we have to reduce it, we have to credit it. So we will credit the interest expense account by 7,200, and we would debit the income summary account, which is essentially transferring this amount to the profit and loss statement or the statement of financial performance. Okay. So every time you are closing any expense accounts, you would always debit the income summary account and you would credit the expense account. Okay. All right. Now let's see what's happening in question C. Calculate the interest expense incurred for the year ended 31 December 2023. All right. So now we have moved into the most recent financial year, which starts on 1 Jan 2023 and ends on 31 December 2023. So let's see what's going on. All right. So we know we make the loan and interest payment every 6 months since the loan was taken. And those 2 6-month period I'm referring to are 31 August and 28 February, right? Now, on that basis, the first interest expense calculation will be for the 2 months starting 1 Jan 2023 and ending 28 February 2023. So interest expense incurred for this 2 months would be 10%, which was the annual rate, multiplied by $81,000, which was the most recent loan balance ending at 31 August 2022, if you recall. If you don't, let me scroll you back up to the bank loan account, okay? Okay, hold that thought. So the bank loan account, 28 February 2023, the balance was $72,000 actually. On 28 February 2023, we had a balance of 81,000 before the repayment of 9,000, right? So remember, before the repayment of 9,000, we had $81,000 left in loan, okay? So let's scroll back down. All right, so 10%. So again, interest expense incurred for the first 2 months starting 1 Jan 2023 and ending 28 February 2023 is 10% multiplied by $81,000, then multiplied by 2 over 12. As usual, we're apportioning the 10% annualized rate into a 2-month calculation, okay? So that gives us $1,350 as the interest expense calculated for the first 2 months, okay? We know on 28th February, we're going to make a loan repayment of $9,000, which means our loan balance at the end of 28th February 2023 would be the difference between the previous loan amount of $81,000 minus the $9,000 new repayment, which would leave us with $72,000, okay? Then from 1 March 2023 until 31 August 2023, which is the 6-month period, we will calculate the interest expense on this $72,000 loan that's left. And how do we calculate it? So we multiply 10% the given rate on the $72,000, which was the balance left at 28 February 2023, and then multiply with 6 over 12 because, as you understand, we are doing it for the most 6 months, okay? So, and that takes care of the 10% annual rate, which gives us $3,600 as the interest expense incurred for 1 March 2023 until 31 August 2023. Now, we know on 31 August 2023, we're making a loan repayment of $9,000 again. So how much loan will be left after that repayment is done on 31 August? $72,000 being the previous balance from 28 Feb 2023 minus 9,000, which would leave us with 63,000. Okay. Now, for the last 4 months in the financial year ending 31 December 2023, which is 1 September 2023 until 31 December 2023, if you want to find the interest expense that we have incurred, you just use the given rate of 10% multiplied with the loan balance of 63,000 from end of 31 August 2023 after the repayment was made, and then multiply it with 4 over 12, because this time we have used the $63,000 for 4 months. So 4 over 12 takes care of the 10% annualized rate, and then we get $2,100 as the interest expense incurred for the last 4 months starting 1 September 2023 and ending 31 December 2023. Okay? Now the question is asking, calculate the interest expense incurred for the entire year ended 31 December 2023. So basically, whatever happened from 1 Jan 2023 until 31 December 2023 for interest. Okay, so during this entire year, the total interest expense for this entire year would be $1,350, which was for the first 2 months of January and February. Then $3,600 added, which was for the months of March, April, May, June, July, August. And then we add $2,100, which was for the last 4 months of September, October, November, and December. That gives us a total interest expense of $7,050 for the financial year that started on 1 Jan 2023 and ended on 31 December 2023. All right, so that's all for this question. Okay, so I believe you found value in this content. Make sure to like this video and subscribe to this channel. And if you need monthly coaching sessions, check the link in the description to book a free call with me. You can bring your parents and we will have a chat regarding your monthly coaching or tutoring requirements to help you prepare for the exam. So I'll see you in the next lesson.